Hello, hello. Welcome in. Welcome to our life insurance beginner friendly webinar. I'm so glad to have you all here today. Life insurance can be overwhelming and even confusing because there's so many companies that you can work with, there's so many options. So I'll try to keep it simple because our goal is for you to leave here feeling educated on what's out there and understanding which policy might work best for you and your family. Now, you can go ahead and start typing questions in the chat as we go on, and I'll go over your questions towards the end of the webinar. So some of you may be familiar with me and what I do, but for those who aren't, hi, my name is Alicia. I am a wife, a mother, and an independent licensed financial professional. So I'm an independent professional, so I do not work for one specific company. I'm contracted with several companies, which is nice for my clients because I'm able to offer different solutions from an unbiased point of view. Because I work with several companies, we're able to work with a company that provides the best solution for the client that I'm helping, right? When you meet with another advisor that represents one specific company, typically they're going to offer you solutions that only that company offers, right? Which makes their options somewhat limited. To those of you that are new here, I help my clients with retirement planning, life insurance, debt solutions, saving strategies, and Medicare plannings. So I do quite a bit, but today we're going to focus on life insurance. Here's today's agenda. You will learn what life insurance is, why life insurance is important, the different types of life insurance policies, how to choose a policy, and how I can help you. Let's start out by defining life insurance. Okay, so life insurance is a contract between an insurer and a policy owner that guarantees the insurer pays a lump sum of money to named beneficiaries when the insured dies. So the insurer will represent the insurance company that the policy owner has the contract with. Often the insured and the policy owner are the same, but they can be different. So, for example, you may be the insured who was approved by the insurance company or the insurer to have the policy, while the policy owner is someone else of interest. Maybe they're the person paying the premiums. Sometimes the policy owner may be a trust, right? If there's a family trust. And the beneficiaries would be the individuals who would receive the death benefit payout when the insured passes away. And a trust could also be the beneficiary. Okay. Now, why is life insurance important? Now, you may hear online and in your travels, sometimes people say life insurance is a scam. It's this, is that, right? Let's talk about why it's important. So, life insurance provides financial protection for families. For example, some policies offer living benefits. So, if you have a chronic, terminal, or critical illness, you can access that death benefit to apply to expenses while you're sick, right? There's income replacement. For example, if someone's spouse unexpectedly passes away, a life insurance policy comes in, pays out a death benefit so that the family doesn't financially crumble. Some policies accumulate cash value, which the owner can borrow from. It allows families to remain financially stable or to create financial stability. Also, legacy planning is available where you can leave a large death benefit behind to your children or your grandchildren. Some policies, if structured properly, can create a retirement income stream. Health benefits, again, that would be your long-term care, your chronic, critical, or terminal illness riders that would apply if you qualify for those, where you can access that death benefit if you're ill. Estate planning, and it can provide a reduction in taxes because withdrawals from the cash value life insurance policies are tax-free. Okay, so these are the main two types of life insurance. You have term and you have perm or permanent, right? Term is coverage for a specific period of time. It comes in a few different ways. You have increasing term, which means for the term period, the death benefit increases over time. You have level term, where the death benefit remains the same throughout the term, and decreasing term, which means the death benefit decreases throughout the term. Now, depending on the client's plans, that would determine which term makes the most sense and how long of a term they need. Permanent coverage is designed to last for the insured's lifetime. You have universal life or indexed universal life, which you may have heard about this policy on social media. It's often compared to investment accounts like a 401k. And then you have whole life, which is the original permanent life insurance. And then you also have variable life insurance, which we will discuss more in later slides. So let's dive into term life insurance. Again, this is temporary coverage for a specific period of time. It provides protection during the time period that you choose, and this can be anywhere from 10 to 30 years, and for some, it's up until a certain age. So for example, people who have Primerica policies, they usually have a term till age 95, for example, but that doesn't mean your premium will not increase. So these policies have terms baked into them. So if you have a policy up until age 95, that can mean after 30 years, you'll see a price increase. And if you didn't know that, or this sounds new to you, go ahead and check out your policy packet, because it should be in the fine print on your policy. And you can also look up this information on their website. Also, with terms, you typically do not accumulate cash value to borrow from with these policies, but some do offer a return of premium option. And how this works is, if you outlive the term, you can get all of your premium payments back and invest that elsewhere. Usually, this is a more expensive option. Now, term policies tend to be very affordable in cost because they are temporary. This policy is often purchased after someone buys a home or if they start a family, right? So in the case of buying a home, if the homeowner passes away, then the death benefit will pay out and the family doesn't have to risk losing the home, right? So the death benefit is there to pay the rest of the mortgage. You may also see this advertised online or in the mail. It's called mortgage protection, right? So that's just, a buzzword for a term policy, mortgage protection. Okay, so here are some cons to keep in mind if you're considering term insurance. 99% of term policies never pay out. Why? Because most people outlive the term, right? So although it's an inexpensive option, there's no additional perks like cash value or living benefits typically. So if you want to renew the term after it ends, the price goes up and then you need to go through underwriting again. So at that point, you're older. If your health has declined, the price could be very high. Or if your health, has declined significantly, you could find yourself to be uninsurable at that point if something, drastic happened with your health. I was helping a librarian a few months ago, and she had a term policy that was ending soon. And she found that to renew that term, it was going to shoot up to an increased amount that is totally out of what she could afford to pay. Now, this was a 30-year term that she purchased in her 20s, and now she's in her 50s. She has high blood pressure and type 2 diabetes. So to get insurance anywhere, whether it's a term or permanent, the price is just totally out of what she can afford to pay, because not only is she older now, but because she has those health issues, even an insurance company that it will approve her, the cost is going to be a little bit higher because they have to take into account that she has a few health issues, right? So now she's going into retirement with no life insurance. So this is an example of how things can go wrong when you get a term, you don't have any permanent coverage, and your health declines and you're on a fixed income. Okay, let's talk about permanent life insurance. So again, this policy is to stay in place for the insured's entire life or up until age 120. Cash value grows inside the policy over time, which the owner can borrow from at any time, which is why people tend to like these for a saving strategy or a college fund or even retirement income. Also, withdrawals from the policy are tax-free. So if you want to access the cash value, you do not need to pay taxes on it as long as the policy is structured properly. It provides you with a permanent death benefit, and it is more costly than a term life policy, but it does provide you with living benefits. So if you have a chronic, terminal, or critical illness, you can leverage that death benefit and use it for expenses while you're ill. Also, some policies offer long-term care. So if you need long-term care during retirement, for example, you can leverage that death benefit as well. So like I mentioned earlier, you have whole life policies, and then you have index universal life policies. Now let's go through some of the differences. With a whole life policy, the premiums are fixed, whereas with the universal life or index universal life policy, you have a flexible premium, which allows the insured to pay a minimum amount, a target amount, or max fund the policy. And that allows them to put additional funds into the policy that exceed the cost of insurance if they prefer, right? Now, the cash value for a whole life policy is predictable because you get a guaranteed rate of return, whereas with the universal life or index universal life, it's unpredictable because it does depend on market performance. The policy is not exposed to market loss because the index universal life policy does have a floor on the account. So when the market is down, your account isn't credited interest. It's 0% interest credited. But when the market is up, you can receive pretty significant returns, more than you would with the whole life policy. But like I said, with the whole life, there's more guarantees and it's a more predictable rate. Now, with the whole life, it does provide you with a guaranteed death benefit, whereas with the index universal life, there's more flexibility. You can have an increasing, decreasing, or level death benefit. And like I said, with the whole life, it's not based off of market performance. Although there are a few companies that have an index crediting option that you can incorporate with the whole life, where you can get a little bit more of a return. But typically with most whole life policies, you're just going to have that guaranteed return and the company will credit you dividends. Whereas with the index universal life, it's going to depend on market performance. There is that 0% floor, and depending on the index that you choose, there may be a cap as well. Now, I wanted to give you a visual of different crediting strategies if this is totally new to you. So for example, with a fixed return, this would be the blue straight line where you have that predictable rate of return over time. So that might be 5 or 6%, for example, that you're receiving that return every single year, right? So this is an example of how a whole life fixed return would look versus the indexed option, which would be how the index universal life policy functions. So when the market is down, you see how that green line flat lines at certain parts. So that would be when you're not receiving any return. So the return would be zero that year, but when the market is up, you'll see that growth. So you see that line going up again, and you'll, have some gains. Now, your variable investment option, this would be like your market facing accounts, or what we would call variable accounts. So they fluctuate with the market. When the market is down, you experience loss. When the market is up, you experience high gains. So this would be, your stocks, your 401ks, how they fluctuate with the market, right? Those are your variable accounts. Okay, so I know that was a lot of info. So here's some of the pros and cons to having a whole life policy and an index universal life policy. So some of the pros with the IUL, or index universal life policy: you have a higher rate of return. You can skip premium payments, right? They're more flexible with the premium payments. Cash value grows faster. There tend to be lower expenses or lower costs, and they reduce your risk of outliving your money, right? Because you do have that index crediting strategy. Now, with the whole life, some of the pros are, like I said, whole life is the original permanent insurance, so it's pretty simple to understand. The premiums are stable. You can kind of just set it and forget it. And there are more guarantees than with the index universal life policy. Now, some of the cons to having an index universal life policy: you must have an experienced agent when working with these policies, because they must be tailored for your family's needs. And I cannot say that enough, because in order for these policies to work to your benefit, they have to be structured properly. And sometimes you will see things online that are negative about these policies, and it's more than likely because the agent that the client was working with didn't set up the policy correctly, right? Now, with the whole life, some of the cons would be slower cash accumulation, because you have that fixed return, so it's not as aggressive. And there are more guarantees, which tends to mean a higher cost, right? Especially in the earlier years. Okay, let's quickly go over VULs, or variable life insurance policies. They are a permanent life insurance policy with an investment component. So like we discussed, they're similar to an index universal life policy. The main difference is there's no floor on the investment side. So if the market is down, your cash value is exposed to market loss. Now, just so you all know, I'm not licensed to offer VULs. So if this is a policy you're interested in, another agent is going to have to assist you with that, and I probably can refer you to someone. But I'm actually not a big fan of these policies, and I would say that's because most people appreciate cash value life insurance because the money can grow more safely via a whole life policy or an index universal life policy, right? But with the variable policies, they're more risky. And if the market drops and there's a reduction in your cash value, it can increase the risk of your life insurance policy lapsing, right? So, like I said, I'm not a huge fan of them. But, they're definitely an option if you prefer something a little bit more risky and you value having life insurance with it. Now, a lot of people get overwhelmed by all of the options available, and that's where the professionals come in. I would recommend you work with an agent that is experienced and also someone who you feel comfortable with, right? Because being transparent is important so that your agent can provide you with the best options. Do not hide things like your health history, because you will waste your agent's time and your own time applying for a company only for you to get denied, right? When you could have avoided all of that by finding a company who is most likely to approve you. I want to go over some examples of different scenarios so that you can have a reference of what would be the ideal insurance type for a person with a specific lifestyle. So let's say we have a male who's 40 years old. He has great health. He's a father of three. He's married, owns a home, and he's the breadwinner in the home. What type of insurance should he get, right? Now, these are some of the factors I would consider when supporting a client like this. So he's likely going to need a large death benefit because he is the breadwinner in the home. So his spouse does depend on his income to provide for the family. He has three children, so if something happened to him and he unexpectedly passed away, there's four people depending on him and his income. He's young and healthy, so he'll be able to get a pretty good health rating at his age and with his health history. So it would be appropriate to get him a large term policy, let's say for $1 million coverage, and that would cover the cost of their home. If he passed away before the home is paid off, it would provide his wife with income replacement so that she could continue to care for their children. And it wouldn't be too expensive because he's healthy and young. So he could do a term for 30 years. And when the term ends, his home should be paid off. His children would be all adults at that point. So it wouldn't be such a big hit to his spouse if he passed away right in the next 30 years. It would take care of them. Now, she would be able to receive that payout and not be vulnerable to financially crumbling, right? Now, what about life insurance past the 30-year term, right? So he's going to need funds or a policy to cover funeral costs because, we're all going to die one day, right? Now, maybe it's important for him to leave a legacy behind to his children. He wants to make sure some money goes to his children and grandchildren when he passes away. So he could get a permanent policy now, whether that's a whole life or an index universal life policy for a lower death benefit, because if he gets a permanent policy, it's going to be pretty expensive if he was to get a $1 million permanent policy. Now, and he might feel like down the line, once children are older and the home's paid off, there's really no need to have a permanent $1 million policy. But could he get one? Absolutely, right? If he wants to leave $1 million behind, sure, he could do that. But if he finds that to be too costly, or maybe he figures he'll have other investments that he could pass on to his children, he could get a lower death benefit amount for in that permanent policy, let's say $150K or $250K, right? And he would still get a good health rating. And when his term is up, he'll have his permanent policy that he already had in place, that he has an affordable price on, and he can just continue with that for the rest of his life. So this is just an example to reflect on, what might be ideal to you or maybe somebody you know. Okay, so let's look at another scenario here. Let's say we have a female, age 25. She's in great health, single and childless, right? Now, what type of insurance should she get? So maybe she feels that she doesn't need a large death benefit because she's single and childless and doesn't have anyone besides herself to take care of, right? She has great health. I might recommend that she get a permanent policy that builds cash value over time so that she can borrow from this policy in the future and use it as an investment strategy if she likes. Now, the cost of insurance would be pretty low since she's healthy, she's young. I want to point out that a lot of people around this age bracket, they don't think that they need life insurance, especially when they're single and childless. But as we know, tomorrow's not promised to any of us, and you do not want to burden your family with funeral expenses if you unexpectedly pass away. I'm sure some of you here know someone who unfortunately passed away during their younger years, and because they didn't have life insurance, the family needed to create a GoFundMe or sell fish platters or something like that to save money to bury that person, right? And you don't have to get a huge death benefit. Honestly, you can get a term insurance policy, but just know that if you get a term insurance policy now at age 25 and it's a 30-year term, at age 55, you're going to either need to renew and get another term policy, which will be more expensive at that point. And if something happens to your health during that time period, you might not even qualify for another policy once the term ends. So that's just something to keep in mind. But you could get a term and just put it on your list to get a permanent policy later down the line when it's more affordable. Let's just say in the next couple years, you're still young, maybe 5 years down the line, you say, okay, I'm ready to get a permanent policy, right? So that also is just an example for some of you to think about. Maybe this scenario applies to you or someone you know. So maybe you're wondering, well, do I really need to get life insurance right now? So I'm just going to give you some reasons why it's probably a good idea. Now, the cost of life insurance increases with age. So you can take advantage of a inexpensive policy if you get it while you're younger and when you have the most optimal health. Now, as you know, tomorrow isn't promised to any of us. Your family needs protection today. I'm sure even if you don't have children or you're not married or you're not in a relationship, there's someone who cares about you and would be there and ready to take care of your funeral expenses if and whenever you pass away. Many families have lost everything because of an unexpected loss, homes, cars, change of lifestyle, etc. And you don't want your family to have to create a GoFundMe or start selling things just to bury you. They're already trying to adjust to your passing, especially if it's an unexpected passing where you pass away very young, right? They're already going through the emotional loss of you. You don't want them to have to worry about trying to find ways to come up with money to bury you. So maybe you're ready to open a policy to protect yourself and your loved ones, right? I would be happy to help you with that. Now, keep in mind, the best insurance company for you might be different than your spouse or your neighbor. And again, that's the benefit of working with a licensed independent agent. If you have a history of health issues, for example, that's okay. I'm able to shop for a competitive policy that best fits you and your lifestyle. All insurance companies have different underwriting requirements. So if you've been denied for insurance in the past, that doesn't necessarily mean you're uninsurable. We just need to find a company that's the best fit, right? Now, you can scan the QR code and it will take you to my calendar and you can schedule a call with me. I would love to help you have a stress-free life insurance planning experience. So here is my email and my website if you would like to contact me as well. I really appreciate you for listening, and I'm going to go through your questions now.